earn more money but too busy to start a side hustle? Do it the right way and teach your money to make more money for yourself, even when you're asleep. Dale Corpus will show you just how here on the School of Cash Flow. With his entrepreneurial mindset and extensive experience in real estate and finance, Dale will help you become a responsible, strategic, and passionate passive real estate investor. Learn how you can increase your earnings or find more ways to make money, only here on the School of Cash Flow.
Hey, good morning, everybody, and welcome to the School of Cash Flow podcast. I'm the host, Dale Corpus. So many of you guys may or may not know, I'm part of a mastermind of other successful entrepreneurs, and it's called GoBundance. You see, I like it because it's a group, and they do focus on growing your business income and your net worth, but I like it because they also push you to raise other areas of your life, like health and relationships and contribution and going on bucket list types of adventures around the world. We just had our annual GoBundance Winter Mastermind, which was an in-person event in Park City, Utah. It was great out there because, side note, I was able to snowboard a couple times, and that was a big thing for me because the last time I snowboarded before that was before kids. So like over 12 years ago, but I survived and I made it. And I mean, I forgot how fun snowboarding was again. So I want to bring that more into my life. Anyway, there was a lot of great networking, and I was able to meet my guest today through GoBundance in person over there. His name is Ryan Stenberg. And you know what caught my attention about him was that he's, young, driven, focused, and he already did a career change in his literally in his early 20s to leave his tech job at Google to go full-time in real estate. And I want you guys to hear his story since many of you guys are in tech. Here's a little bit more about Ryan. So Ryan is a 25-year-old commercial real estate syndicator living in Los Angeles and operating across the country. And after several years of slow progress in real estate, Ryan moved to Reno and left his job at Google. And since then, he and his partners have purchased 40 million of value add multifamily and commercial property through partnerships and syndications. So let's get started. Ryan, welcome to the show. How are you?
I am doing great this morning. Thanks for having me on, Dale.
Yeah,
great to connect with you out in Park City.
No, absolutely. And I'm looking forward to connecting with more on this podcast as well. I mean, I know that you live out in LA right now. And when we chatted in person over at Park City, the other week, I know you're from the Bay Area originally, right? Were you born and raised in the Bay Area?
Yes. Yeah, I'm from South Bay, San Jose.
Uh-huh.
So I grew up in San Jose. Parents eventually moved over into Los Gatos. So I went to high school kind of right on the border there in Lee High School. I know some of your guests are familiar with that area and whatnot.
No, absolutely. And so when you were working at Google, I take it you're working in Silicon Valley as well, right?
Yeah, I was living up in San Francisco and I was commuting down on the buses. This was back when the bus system was, more active than it maybe is right now. And commuting down about an hour to 2 hours a day and then back up to the city. So working in Sunnyvale, but driving down every day.
When you went to college, I'm just curious, I didn't ask you this, but what was your degree in? Was it, tech related?
Yeah, it started in electrical engineering and then pivoted partway through to computer science when I realized, every internship, every job, every side project, startup was all software based. So it just made a lot more sense. And the transfer was easy. And so I switched over to computer science and that's what I graduated as.
Okay, God, I don't know if I shared this with you, but I graduated with electrical engineering degree from Santa Clara. So look at me now, I'm a realtor.
There you go. We all make our way over here. Yeah.
It's a perfect segue. And heck, you ended up in real estate too. So here we are. Before I jump in my other questions, just because we connected through GoBundance, and I don't know how you even found GoBundance. How did you hear about it, and how long have you been? How long have you been in it?
Yeah, I heard about GoBundance probably a few years ago through Bigger Pockets was the first mention of it, but I guess joining it never really crossed my mind until I call this maybe 6 months ago. So I joined back, actually a little more than that, joined back in May of 2021. Kind of takes me back to where we launched off in real estate, actually. So my current roommate now is Will Brown. He's also a member of GoBundance. He's a young guy as well. So early on, we were kind of facing a lot of, slower than we wanted to progress in real estate. And I heard a podcast episode of him and gave him a call. He gave us a lot of, advice that we can get into later and whatnot. And that helped us accelerate our speed in real estate a tremendous amount. And so about a year after that, hearing his podcast, giving him that call, I called him back just to say thank you. And he said, like, hey, you got to come down to LA and visit, and you got to join this group, GoBundance. And that's how I landed there.
Now, like, has it done anything for you? I mean, you haven't been in it too long, but have you noticed has it done anything for you? What have you noticed, if anything?
Yeah, absolutely. I think they say, you're the average of the 5 people you surround yourself with the most, and joining the group and having people think about lots of different facets of life and trying to consciously kind of plan those, and move in the right direction towards those things makes you realize what you might be lacking in, or what you might be not focusing on enough, or what you'd like to put more effort towards. So I joined originally because there are a lot of people in the group that do real estate. There's a lot of people who are, horizontal income is one of those pillars that you mentioned. But there's also a huge focus on relationships and family. And for me, the big pickup was gratitude, that I, recognized joining in GoBundance, that my gratitude was not where I wanted it to be. And this was, in the middle of the pandemic kind of. And so I think a lot of us slipped in that dimension.
Yep. I think that a lot of my listeners, they work in tech, and you're very relatable because you were at Google. By the way, what did you do at Google? What was your job?
I interned there as a software engineer, and then I was a program manager, so a technical program manager in cloud and platforms. So helping to launch a lot of GPU, TPU like style hardware that would land in data centers. So kind of built all the way down to the ASIC up to the cloud level software.
Yeah. I mean, like, there's no doubt, Ryan, you're a sharp guy, and it's like you were in tech and you had a great job, and a lot of people would, kill to, work in, Silicon Valley and Google and whatnot. But I just find it really interesting how you already did, in your 20s, you switched careers to switch to real estate. Why the heck did you do that?
Yeah, actually, interestingly, my answer probably a couple months ago would have changed to what it is now. When I first left, I started buying into real estate as a way of putting my money somewhere more useful than at the bars. And I realized I need to find an investment that I can get more excited about. And so I started looking at real estate as something that's more tangible than stocks. I could not get excited enough about stocks to actually save money and then put anything there. And I realized, for the first time in my life, I'm making, real money here. It's non-negligible amounts, and I should be putting that somewhere useful. And so I needed to find something I could get excited about. And for me early on, that was real estate, just because it was more tangible. And it got me excited. So I started buying real estate, started moving slower. But then I was doing the math and realizing, this is actually a true predictable path to being able to one day, leave your job and work on other things. And for me, work on other things is, I've come from the startup world a little bit, and I've tried at a few different startups and really like that and would like to get back to it. And so for me, this was the path to basically building some financial independence, some horizontal income that would allow me to re-enter that startup world with maybe slightly lower risk or, less financial risk at least. So that's what got me into real estate early on. And I went after that really heavily. Now looking back at it, I realized there were also a lot of things about not necessarily Google, but about the common pay structure I was just very dissatisfied with.
I got it. When you first got into real estate, did you already work with partners, or were you doing it by yourself? And they also wanted to get a sense of like what you started off with as like your first investment.
Yeah, I started buying with my best friend from high school, and he was my same year as me. We were both in the same boat, starting in tech in Silicon Valley, and we had some money coming in, and we decided, let's save up every 6 months, let's buy something out in out of state. We were living in California, so out of state, and we would pick up a triplex or 4-unit building every 6 months or so together, and that's what we did for a little bit. And to be honest, we only got about 2 buildings in before we realized, this is slower than we want it to be. It was this kind of buy and then save for 6 months, and you don't really get to can't really take much action during that 6-month period because you're just waiting for your funds to recuperate. And so became a little bit slower than we wanted it to be, but that's where we started.
Okay. Where out of state was it? Was it already in Reno that you started?
We were buying in Cincinnati, Ohio at the beginning. We picked it largely just by saying, okay, you have 5 days, research cities, and let's come back with a list. And that was the only city on both of our lists. So that's where we started buying.
Okay, I got it. Because I know that you also, bio and whatnot, you also picked up stuff over in Reno and whatnot. What made you pick Reno?
Yeah, so this is kind of when I was having that realization that this is moving slower than I wanted to. And my business partner that I mentioned, Alex, and I were in a mastermind group. This is before I was in GoBundance. So I was in a mastermind group with one other guy, my current business partner, Abe. And we were talking a lot about real estate, a lot about how to accelerate this pace and move faster. And so it's all kind of lined up with the beginning of the pandemic. So we were actually, Abe and Alex were all flying in. We were going to take a weekend in the Santa Cruz Mountains in order to kind of plan out the year and when it comes to real estate and other things. And then that's when the pandemic started and all the emails went out saying, hey, you can't work at the office anymore. And so instead, we just took a flight to Hawaii. We flew out to Hawaii, stayed there for a week, and basically just thought about what can we do differently this year that we haven't done in the past? What will be enabled by this situation? One of those conclusions we came to is, we have the ability to move anywhere right now, live anywhere, and we can really pour a lot more time into real estate because we're not commuting, for me, like 2 hours a day each way. And so I took all that time, took all that kind of energy, and we ended up, after a couple of months later, we ended up moving to Reno because a lot of other investors, we kept hearing Reno from other investors. And we realized if we wanted to go faster, we need to find a way to do it with, without using all of our own money. And that was the rate limiting factor for us working our jobs in tech and just saving up. So if other investors are extremely interested in Reno, then let's move out to Reno and let's be boots on the ground for those people who are interested in moving, the speed that we want to move. And so we ended up moving out to Reno, and that's where we bought for about the next 18 months. We bought all of our assets there.
So in Ohio, you were using your own money, but when you moved over to Reno, is that when you started bringing on other investors?
Yes. Yeah. So we didn't actually intend to syndicate at the beginning. We landed in Reno with the intention of wholesaling to these investors that I was talking about, finding multifamily property or whatnot and wholesaling to them. And we kind of failed at that and weren't able to wholesale these properties. Either they weren't large enough or they weren't what they were looking for. But now we had them under contract and we'd done the due diligence and we knew we liked the projects. And so we kind of took a right turn and pivoted and just started raising funds instead.
So, and then what types of properties mainly were you focusing on in Reno when you were bringing on other investor capital?
In Reno, we originally went there looking for multifamily because that's what we knew. So it was 8 units, 10 units here, 5 units, things like that. So generally the 5+ unit range for multifamily. If we could get more, we would, but Reno's not a very big city and there's not a lot of large buildings there. And so that's what we originally went there to pick up because that's what we were comfortable with. But at a certain point, we started seeing more and more commercial properties, commercial meaning office, retail, industrial, mobile home parks, and things like that. And so these started landing on our plate more and more. And the opportunities seemed a little bit, seemed larger and larger. And so we started to shift our focus towards that about halfway through Reno.
Okay. And how were you finding the deals? Were you finding them? I know that you were trying to wholesale and whatnot. So you probably did you have systems where you went directly to, find sellers yourselves, or you're also working with brokers, or was it a combination of both?
Yeah, that's a good question. So it started off as direct to seller and it ended up being both brokers and going direct to seller. And so the reason for that is we realized, we're coming in here with very little experience,
right,
no money. Like, what do we have to offer in terms of value to anybody around us? And that includes brokers, it includes investors and other things. And so our thesis coming in was, let's control deal flow better than anyone else out there. I think that deals are the bottleneck and the shortage in the real estate industry right now. That's what we kept hearing from every investor, broker, lender. And so we said, let's be the best at sourcing deals, and that'll be our value add. And so we went direct to seller through basically mostly SMS. We A/B tested almost everything out there. Ringless voicemail, mailing campaigns. We dropped off wine bottles at people's houses. We did door knocking, We some kind of funky other stuff, and we tried all of these things and recorded our results like someone in Silicon Valley would. And then we found that SMS worked the best. It was the most scalable, and it was the cheapest per acquisition. And so we ended up going direct to seller mostly through text messaging. And from there, what we would do is we would bring these lists to brokers. We actually wanted someone who was a local expert that had been in Reno 6 years, not 2 months like us, who could help be another set of eyes and ears, an expert set of eyes and ears. And so we would bring our lists, our off-market deals, to brokers, and they would take a look at these lists and they're like, how are you finding all of these off-market deals? And so that would be our value add to brokers. And most people see the broker relationship as the broker brings me a deal and then I do the deal, and that's the relationship. And we kind of flipped it upside down and said, we're going to bring brokers a deal, and you need to, one, keep our earnest money safe, two, provide all of the market data, research, and confidence, and then connect us with all of our teams and systems. So lenders, contractors, and things like that. So we just kind of said the value proposition for us is going to be different with the broker. But what ended up happening is months later, after we had brought them 2-3 off-market deals, they started, we jumped to the top of their list. These are brokers we would never have been able to jump to the top of their list early on with the track record that we had. But because we were providing some auxiliary, some other value, they started sending us all the deals they would find. We would be the first on their list to see those. And so it ended up being a blend of direct to seller and brokering.
I think it's genius, because I was about to ask you, my question was going to be about, you're being so young, how did you get brokers to take you seriously? But did you ever see your age being, a disadvantage to you? Is it a disadvantage to you even right now? Or what are your thoughts on that?
Yeah. Good question. I think I would definitely be lying if I said that I did not see my age as a blocker early on. And, real estate's kind of an older man's game, and coming in at 25, you get a lot of weird looks when you show up at the property and they're not who they're expecting. And so early on, that psychologically, that definitely wears on you a little bit. But what I found is the same thesis that we had of let's control the deal flow because that's the most desirable asset kind of shadowed all of that, the age. And so when you show up with a deal that's strong enough, a broker doesn't really care what your age is or how you found it. I mean, I guess they care how you found it, but because they sometimes they want to replicate, but they don't care about your age as much. If the deal is strong enough, they're like, this is a solid deal, we should move forward with it. And so we found that to be true from the broker side, found that to be true with lenders, and we found that to be true with investors as well. And so one of the big hurdles I had to kind of get over psychologically was realizing, there's this catch-22 that I see a lot of people get caught in, where they say, I don't have a track record, and without a track record, I can't do projects or raise funds or get debt. But until I get debt or raise funds or do a project, I can't get a track record. And if that loop is true, then you are stuck forever. You'll never get anywhere. And so obviously there are people who got in and that's not true. So that loop cannot be true. And there must be something that breaks it. And so for me, whatever psychological hurdle you need to step through, you got to find out what it is that you're able to kind of maybe even trick your subconscious or your mind into. But for me, it was this acknowledgement that my life has been my track record. It's not in real estate. It's where I've worked. It's what I've done, companies I've worked on and built, or who I've been as a person, as a trustworthy person. And that's what's going to carry me through, that story is going to carry me with lenders. It's going to carry me with investors, even if it's not a real estate focused one. So it's the meticulousness of how you work at your job and the people who know that. And by your job, I mean, at that time at my tech job. So that kind of helped me get into real estate and overcome that age hurdle to the point where now I actually see the young age as a benefit. It gets people's attention early. And I know that we have the track record as well as the deals to back that, I guess, upfront odd look.
Yep. So just what jumps out at me is this, again, control the deal flow. I mean, that's genius. It's how did you even think of, putting how did you finesse your systems? How did you even come up with, I'm just dumbfounded by you're able to bring all these off-market deals to your broker. How did you even know where to start with creating these prospecting types of systems? Were you modeling, other folks, or did you figure it out yourself, or how did that go about?
Yeah. So earlier I mentioned my current roommate right now, Will Brown, he's in GoBundance. And so he had a podcast on Bigger Pockets. that didn't describe exactly what we do. But when I heard his podcast, just a light bulb went off in my head and all these pieces started connecting together. His thesis was that deal flow is, everything. And he was starting a wholesaling business for single family homes out in Virginia, or that's what he was working on at the time. And he's talking a lot about systems to catch, catch every single lead possible that was coming through Virginia. And so I said, well, why not the same for multifamily? And if that's true, my background was in tech. And so I started thinking a lot of this is just a numbers game. It's just volume. I hear all the time, different investors or different podcasts out there, people talking about, how many deals did you analyze this week? How many offers did you make? There's this pipeline or this funnel that kind of narrows down to what you get an escrow on or what you get into contract on, and then what you end up buying. And how wide your funnel is at the top is one of the most relevant, if not the most relevant part. And so I just started putting that all together. When I heard, Will's podcast, the system that he built in Virginia, I started saying well, what if we just use, our background in software and our background in tech to do that same scale, but even broader. And so we started putting together, we actually wrote the original software ourselves. So my business partner, Abe, was at Amazon and Alex at PayPal. And so we started putting together a system to message people. And so that system, when we got to Reno, we could message every property owner in Reno for multifamily within 3 days. And then we'd follow back up with them 2 weeks later and 2 weeks later and 2 weeks later. And so we would catch, anyone who was looking to sell. They say there was a very small window of when they're ready to sell, but we were going to be there, and we were going to be there for the entirety of the Reno market. And so that worked for us in Reno. And then we kind of got our heads down in the excitement of it all and trying to learn how to do real estate syndication and learn commercial assets and other things like that. That we forgot how the system was built to kind of scale broader than Reno. So for about a year and a half, we kind of focused us in on that market, which was maybe a good thing. It let us build our network there, let us build our confidence in the deals we were doing and the asset classes and things like that.
Okay, got it. And so you have your own proprietary system that you literally built yourself, your own group, right? And is that the same system that you're still working off of right now? Mm-hmm.
No, it's not. So we originally built that because we had, as I said earlier, no money, no track record, no reason to bet that this was the way, this would work out. This is the golden, the silver bullet. And so originally we didn't want to put, 30 grand into a bet or something like that. Or maybe we couldn't actually do that. So we built our own software to keep the costs low. After about a year, we realized this, every couple of days we have to get in here and our code breaks and messages stop sending. We have to get in here and rewrite code, which is not an ideal way to do a real estate business. And so it's not like we were planning to sell this software or whatnot. So we looked up other softwares out there and we realized you can actually string together a lot of software that exists out in the market that you can pay for. And so now we've been able to do that where we can pay for other people's production ready software instead of our own hacked together version. And for very reasonable costs, we can go into a new market, get all the data ready and message people in that market. So now we're not using anything proprietary. We've closed all that off or shut all that down. It was just a way of keeping costs to a minimum while we made the bet early on.
What just jumped out at me. I remember you just said that you tried even delivering wine bottles to people's doors. Did that ever turn into a lead out of curiosity? And why did you even think of that?
Yeah, we kept, I don't know if we ever did that cold, but we did deliver bottles to sellers that we had been talking to over text and seemed to like us, wanted to sell, but just couldn't pull the trigger. And we're like, let's get something to push them over the edge maybe. And, they seem to want to sell, but they're just emotionally attached, right? And so we delivered to them. I don't think any of those converted.
But did you have systems so where were we getting the data to put into the software? Where was that? Where were we did you target specific lists? Were you targeting entire city or what did you do? Yeah. Did you filter stuff out? Mm-hmm.
Yeah. We would start with lists pretty much for the entire city. We would pull the list of all addresses for multifamily in Reno. And that would be our starting point. And then you have to find a way to, a lot of that information is public about who owns the property. All you have to do is figure out how to get phone numbers out of it, which there's a slew of softwares out there. It's all called skip tracing software. We A/B tested basically the initial lists and the owner names that were on there. Then we A/B tested across the different skip tracing softwares that were available to get phone numbers out of. And then we would send messages. And so we A/B tested the different message sending platforms once we ended up kind of switching off our proprietary stuff and going to paid versions. So there's a bunch of different messaging softwares where you can send SMS at scale. So we're not sitting there on a cell phone and messaging people, which is actually how we originally did it.
Oh, wow.
We created an app that we would all sit around in a circle and basically just message people all day long. So there's 5 guys in an apartment.
Your fingers must have been hurting.
Yeah, basically it would just fire off initial messages and we'd get responses. And when the response comes in, we would take it over from there. And there's 5 of us. We're like, all right, I got this one. No one talked to this person, and that would be it. And but eventually that had to go away. We had to get a little better system. But it was a funny time. So yeah, anyway, that is kind of the string of software tools that we put together to make this happen.
Yeah. Okay. Got it. And I mean, so do you spend a lot on, or just curious, how much do you spend on marketing and like your marketing budget in general now? Is that a, big, is that a big chunk of money spent out of there or like?
Yeah. So in Reno, we were there for about 18 months. We probably did about 10 projects and the marketing costs were less than $5,000. We were buying, we bought maybe $10 million worth of property out there, actually probably $13 million of property out there and made it worth 25 or so. Okay. And that costs us about $5,000. In other markets that we've gone to now, we can pick a MSA anywhere and we can get through at least one pass of messaging everybody in that market. And within an MSA, let's say the size of like Raleigh, Durham, which is where we focused a lot recently, for somewhere between $5,000 and $10,000. So the marketing costs generally will pay for themselves and then some within the first deal. And hopefully we'll get another 4 or 5 deals out of it after that. So it's been, the marketing costs have been no problem in terms of being a bottleneck.
Okay, got it. And you mentioned North Carolina. Is everything now, is the focus mainly there? Is Reno still in play or what's going on with that?
Yeah, we just purchased property in Reno actually about 2 weeks ago. So we're still buying in Reno. It's slowed down because we have messaged a lot of the market. And to be completely honest, Reno is a small market. I think we've ended up scooping up a lot of the value add properties that were ready to sell at that point in time. Mm-hmm. And it's kind of like a tree, those will regrow. Those fruits will regrow and there'll be more opportunities out there, but we're going to at least let it cool off and give it some time. I also think Reno has seen a ton of growth since we got there. There was, rent increases of between 20 and 60%, depending on the bedroom count. Just for the 18 months we were there. And, so we were the benefactor of a lot of that growth. And so we focused on other markets now where we believe they're still on that steep part of the curve.
Okay. When you chose North Carolina, Raleigh, right? What metrics did you look like? What metrics did you look at and whatnot, or what made you, for example, pick out of there? Was it the metrics? Was it the relationships? Did you have existing relationships that you leveraged on out of there? Just trying to understand how people are picking markets.
Yeah, totally. So what we did is we pulled every market it was basically larger than Reno, but smaller than these tier 1, Austin, San Francisco, New York style cities. Yep. We pulled all those sizes. Then we looked at population growth over the last 20 years. We looked at median income growth over the last 20 years. We looked at crime rate and reduction and a couple other metrics. We pulled all these in, kind of filtered based on the ones that were seeing the best population income growth, the most crime reduction, and most housing growth over the last 20 years. And then we just narrowed that list down. We had landed with about 20 cities, and we kind of stack ranked these cities as ones that we'd be interested in. So we're interested in all of these cities. Then we would go and search for, of these cities, who do we know in these different places? And so we went around asking for connections and saying, we're looking for an operator, someone who can be boots on the ground and can bring in contractors, and bring in tenants, negotiate with local people, understand the market rates there and stuff like that. And so Raleigh Durham is one of the markets where we got connected with a broker who we've been doing a lot of business with and are actually transitioning more towards bringing him on as a GP in a lot of our syndications going forward. So that was a kind of the deciding factor. Once we have a list of 20, we're like, these are all great markets. Who do we know in these markets?
Got it. And then did you also leverage the same systems you built to also, give that broker potentially off-market types of deals, and that's how you got his attention?
Exactly. So, this broker, he used to manage, the Port of Everett up on the north side of Seattle, huge property up there. And so he had a million square feet of under management out in Raleigh. And it's probably not someone we would typically be able to get in front of very easily. So what we did is we started our, deal flow pipeline. Took us a few weeks, and we ended up showing up saying, hey, I would like a Zoom call. I need help assessing, market rent for these properties. And we would just share our screen and walk through a list of 200 off-market commercial properties where sellers had given us their price that they would sell for. And we're like, I don't know any of these areas. I need help understanding market rent. I need help, understanding where the strongest deals are. And we would work our way through, and we'd be about 20 through, and 20 through that list of 200 properties, and say, this is going to take forever. Can I just send you this spreadsheet? Help me, fill in the comments and notes and all this stuff, and let's see if we can do some business together. And if it all goes well, I'll have another list of 500 more, in a couple of weeks. And so you kind of show, honestly, we're very transparent and open with that trust early on, and always keep in mind, we're looking to bring future work as well. And so as long as we bring those two things, we don't expect to get burned, or we hope we don't get burned, and we don't expect to. And if they do, then, we lose our, the first couple hundred properties, those offered or those options, but we have more coming. So that's helped us get in front of brokers pretty fast.
Okay. What's a typical deal that you guys go after? Can you describe that?
Yeah. So it used to be, as I said, more multifamily. The workload of multifamily just started becoming too overbearing, meaning when you get a multifamily property, you'll typically go in there, rehab all of the units, or at least most of them, and then you'll place tenants. And that's because, there's kind of a cookie cutter template for what you should rehab into. And there's some variations, of course, but in the general sense, tenants are more predictable on the commercial or the residential side. Yeah. And so you build first, and then the tenant shows up. Now we've started moving towards commercial. So we've been looking mostly at industrial buildings. So industrial warehouses and manufacturing, cold storage, things like that. And in that space, what you'll do is you'll usually market the building as a shell. The tenant will show up and they'll tell you what improvements they need. A lot of the time, they'll do those improvements for you. So we have a retail building out in Reno, Nevada, where we marketed the building. A tenant showed up, said, I'd like to put a bar in here. And we said, great. What improvements are you going to, do to the building, or what are you asking for? They said, we're going to put $250,000 into the building to do our improvements to make this a bar, and we're going to manage the rehab. We said, great. And they signed a lease saying that they would do all of that. And now they will manage the rehab. They will work with the city. They'll bear the risk of the ups and downs of the uncertainty on that rehab. And so in the commercial space, we like that a lot because it scales a lot better. So we can do more deals kind of in parallel as that work gets offloaded to tenants. The deals that we're looking at right now will generally pick up a vacant industrial building is the most common. We try to buy it at the cheapest price per square foot we can, rent it out, and we're aiming to usually double the building value or triple the building value. And so that's kind of our exit. And a lot of our deals are either kind of positioned to exit within 6 to 12 months or hold on to it for 10 years.
Got it. So you're already, so you're looking at deals right now already in the triple net lease assets, correct?
A lot of it's triple net lease assets. Yeah. It's not, I guess not all the leases are triple net, but commercial assets are, a lot of the tenants Absolutely. Are carrying the expenses.
Going back to, switching topics to just raising money. I'm curious, how are you going about raising money? Again, you're so young, on the younger side, it's how do you attract all these investors?
Yeah. So raising money used to be 5 of us surrounding a whiteboard, writing down every name of every person we knew, and then calling or messaging them. Early on, that's what it was. Or everyone we could think of who might be accredited or sophisticated or whatnot. And then we would give them a call and say, hey, I have this project. It's really good. And that's how we would work. Today, that gets easier over time. That's how it starts. And it's extremely difficult until you've done a couple projects and the investors have seen the return out on the other end. And so after we've exited these investors, they said, yeah, just roll it again into the next one, And so then we had our hard money lender on our first project who said, our first project took us 3 months. He said, I'm not making any money if you only hold for 3 months. So I want to be the equity investor next time. And so then our hard money lender came in. Our neighbor next door, he asked what we were doing. And turns out he had made a lot of money on crypto and was looking to move it out into real estate. And so he's become an equity investor. So we've just been kind of picking up auxiliary people around us, I guess, because they've been hearing the story and the progress, and they've been looking to join in. A lot of it is still friends and family, actually almost exclusively. And so now fundraising looks more like making a couple phone calls to the investors that we like working with the best, the ones that are the easiest and the smoothest, who will make a decision in an hour, and then we can move forward and we know the terms already and things like that. So it's been a lot smoother recently, but it used to be days of staring at a whiteboard trying to think about who else have I not called.
Got it. How did you learn how to, already be a syndicator? Like when you started raising money, and it's just like, your progression in real estate, it's pretty, I feel like it's gone really pretty quickly and whatnot. How did you figure out how to already be a syndicator so fast?
Yeah, as I said, we kind of tried to wholesale it first, and that was the plan. And so we went out to Reno. We put a property under contract, an 8-unit. We tried to wholesale it. It wasn't big enough for the investors that we were trying to wholesale to, but we'd done all the due diligence, the inspections and whatnot. And we're looking at this project, and we drew out all the scenarios, and we said, there's very little risk here. And this is a pretty solid project. What if we tried to raise the funds? How much would we need? And we just did some math and realized it's like it's a reasonable amount, something that we could go and ask friends and family. And so we went and asked friends and family and kind of stumbled into it that way. And so we were able to raise, half the money pretty easily. And it's like, we're halfway there. Let's just push to the rest of the way. And so it's kind of this perpetual, failing forward, I guess, scenario. And the first time it wasn't meant to be a syndication when we entered contract, and it ended up being one. Later on, we intended to syndicate, on the next projects. And so it was a lot more structured. So we started figuring out, how do we do this correctly? How do we, started working with syndication or SEC lawyers, as well as, kind of more robust, partners all around us. So it became it was a kind of a failure at first, transitioned into a happy success. And then we just kind of piled on from there.
Got it. Since you moved away more so from multifamily and now your focus is like industrial commercial, has that raised any issues with your investors? I mean, multifamily, a lot of people understand and whatnot. Industrial is more foreign to most people.
Right.
Are your investors are these same investors interested in the industrial commercial space direction that you're going towards?
Yeah, so actually every investor that was originally in our multifamily syndications has now transitioned over, and they are in one of our commercial syndications. That said, there was a barrier, there was a hurdle to jump over there, because there was a moment of uncomfortability where, we had to learn this asset class, and now we have to teach them this asset class. And one, I'm not comfortable taking money from anyone who doesn't understand the asset and what the risks are. And two, they have to be willing to commit the time to kind of understand and learn. And we're willing to provide that education, but they need to, they need their time and their energy committed. So eventually we got them all in. Once now that the first projects are starting to wrap up and we're looking to exit those, I think it's become very easy now. They're very bought in to industrial property and understanding, how the economics of it work. So now it's become a lot easier, but there was definitely a hurdle switching over.
Well, what was the process like then? Because again, I'm sure everybody was new to the industrial, space and whatnot. How did you make them feel comfortable? What kind of education did you give them?
Yeah, so we believe, every time we step into a new asset class, we are extremely thorough, and we only do a slam dunk, home run project. So the first project we do, we're looking to buy at a huge discount, have a ton of upside on the purchase. And so we focus it all in on safety. So when we originally went into multifamily, we drew up every scenario that could happen. We said, well, what if COVID extends for 2 years and there's a rent moratorium for the whole time? What if the rehab goes over budget by 3x? What if this the operator that we have planned coming in goes out of business? And so all of these things, if they all pile on top of each other, what does that decision tree look like? And where do we land? Are we okay with that worst case, financial scenario? What if interest rates go up? What if cap rates go up? And so if we model all of that out, fortunately, we had to walk our investors through, these are all the things that could go wrong. And if they all went wrong, here's where we'd land. You'd pretty much get your money back and, nothing else. And so as long as they're okay with that downside scenario, that's, then we think this is a project worth moving forward on. Now, of course, the upside, the scenario where that decision tree takes you down all the positive things, it ends up looking a lot rosier. But we want to make sure people are comfortable with that worst case scenario. So early on, we're extremely thorough there in pulling data and doing our research. And so we will go and in commercial buildings, for example, we'll put up a LoopNet listing while we're in escrow. We'll search for tenants while we're in escrow. Oftentimes we'll sign leases while we're in escrow. So we try to remove as much of that variability and uncertainty while we're in escrow as possible. There's been projects where the day we close, we filled the entire building. We went in contract vacant, but we filled the entire building. And now we're closing and all the value's already been added. And so that risk has been removed. And so for us, risk mitigation is the number one, like most important thing in all of these projects. And so especially early, convincing people to get on board, we weren't willing to take big bets. So we had to kind of wait for the right opportunity to jump into this space where there was a no-brainer project that we could take on and kind of get people comfortable with one with a lot of room for error.
Yeah. How do you structure deals with your investors? Preferred return or like what's your profit sharing? What's that kind of like?
Yeah, we have two structures that we've pretty much only exclusively done these two structures. The first one is what we did the first 10 or so of our deals with, which is we don't take fees and we don't do equity. We just do profit sharing. And there was no preferred equity either. And the reason for that decision is I think a lot of syndications are structured in a way where there's fees taken out early on. So before the work has been done, before the risk has been mitigated, there's fees extracted out. And then there's also equity that the sponsor will take on the day of closing. So a lot of times on the day of closing, the sponsor has already, won a lot. And it's true that they've done a lot of the work. They've already acquired the property and that's half the battle. But we wanted to defer everything that we take out of the deal until the end. And so we only did profit splitting. So if there's no profit on this project, we're getting nothing. And we don't want to take our reward out early. So that was the main reason, was aligning the incentives with investors so that we only take profit if there's if we can generate upside. And the other part was, it was just simple. So we were raising money from a lot of friends and family who weren't super adept at, or, knowledgeable about syndication structures and, waterfalls and things like that. And we wanted to keep things simple. So we went in saying, depending on the project, sometimes it was a 75-25 split, sometimes it was a 50-50 split on the profit. And it just depended on how much upside there was and how much safety there was in the project. But we would come in saying, that's, we're just going to total it up at the end and we're going to split it down the middle, whatever the profits are. And so people could get on board with that understanding. That's model number one. Over the last few months, we've transitioned and we've started doing some projects on a pref equity structure where we do just a preferred equity that's usually quite high but capped. And so that means investors will get the first 15 or 20% or whatever it is of all of the cash flow that's coming in, but we'll cap them at that number as well. And so if there is more profit exceeding that, then that would be exclusively ours. And so this model is more predictable, safer on their side, but less sharing the upside. So depending on the investor, that's sometimes preferred. And sometimes it's, sometimes people want to share in the upside because they're looking for a higher risk profile. So they want the profit splitting structure. So we've done both of those.
Got it. And then remind me again, how long are the hold times typically in your deals?
Yeah. So in general, we our favorite project is the one that you can hold for 10 years, but you can also exit in 6 with the value added. And, I like to think, or I typically think a lot of syndicators go after a 5-year hold. Yep. And I think the 5-year hold is honestly, I've pitched investors on 5-year holds and I pitched them on 3-year holds and I pitched them on 10-year holds. There is a big hurdle after 5 years when you ask to tie people's money up for 10 or to tie it up for 7. There's something psychological about it that makes it a lot harder to raise money. And so I think a lot of syndicators will raise money on a 5-year basis because that's what they can, it's the easiest to digest. But I actually think a 5-year hold is one of the most dangerous timelines out there because you can generally predict where the economy is going to be 6 months from now, or at least real estate won't be able to react fast enough as an industry to a fast downturn. You can usually predict where the market's going to be in 10 years, or you can at least predict that it's going to be better than where it is today. Yeah. But you can't predict where it's going to be in 5 years. So I'm not a fan of the 5-year hold. I'm a fan of coming in saying, hey, this is going to be 10 years, but we're going to sell opportunistically if we get a really good offer at some point. And so a lot of the times we will come in saying, are you comfortable with the 10-year hold? And we'll get investors to say yes and get on board with that scenario. But we know our plan is to add the value in 6 months and exit to some off-market, 1031 buyer 6 to 12 months in. And so that's been our frequent pattern for a lot of our projects.
Got it. Now that you're focusing on industrial right now, what kind of challenges like are you either facing now, or do you see like potentially in the future in that space?
Yeah, totally. So there's a lot of variables in the industrial space. I would say that probably the most important overall is just what is supply and demand. And this is true for all asset classes. Are we, have we overbuilt supply, or is there, is vacancy really high or is vacancy really low? And right now in most of the cities that we're interested in, the vacancy rates for industrial are around 3%. So what we're seeing is that there is heavy demand for it. There's a lot of businesses that can't find space, and there's a need for more supply. Now that industrial supply can be built out, over the next year or so. So I wouldn't say that's why we kind of like playing in that 6 to 12 month window, is we know everything that's in progress, everything that's being built out there over the next 12 months. I can't tell you what's going to be built in the next 2 to 3 years. So we like that, as long as we stay in that short-term window and can add the value then. Supply and, the demand right now is drastically outpacing the supply for industrial space because of the growth of e-commerce, which has been a trend for the last 10 years and has just accelerated in COVID, and the growth of, data centers and things like that. So there's been a lot of industrial supply that's been eaten up and not a lot that's been built in correspondence to that. So that's one of the macro trends we've been looking at very heavily. Another is just always looking at kind of, I guess, even more abstract is just interest rates and cap rates, which maybe, could see an increase over the next, or actually, I would say almost definitely will see an increase. We're underwriting that increase in over the next year. And so we expect interest rates and cap rates to go up a little bit. And so we want to make sure that we're comfortable with exiting at, a cap rate or 1 or 2% higher cap rate than we would typically, or than we were purchasing at. So we want to make sure that that's digestible as well in our model. But other than that, I think supply and demand holds true. I don't expect any crash in the industrial space until people start overbuilding, and it's definitely far from that right now.
Got it. Currently, how many business partners, or how big's your team right now, in all the syndications that you're doing? And like, I'm curious about that, and what roles does everybody play?
Our team in Reno was 5. So it was myself, Alex, and Abe, I've mentioned. And then it was actually my younger brother and Alex's brother. So it was kind of so Alex is my best friend from high school. So it was a group of kind of 5 guys who all went to the same high school. We had somewhat dynamic roles. Someone generally took over the rehabs and constructions and managed all the contractors, the bids and stuff like that. Yeah. Someone was the primary lending contact. I did most of the fundraising and the underwriting, and then someone would be on acquisition. Abe would kind of lead the acquisition charge the whole time. And, his goal, we always had this dynamic, and that this persisted after we left Reno, and we're still doing projects out in Raleigh and other places. Abe was always trying to generate as much deal flow as possible, such that I could not handle all the escrows that were coming in. And I was trying to handle all the escrows and raise funds and say, Abe, you need to give me more deals. And we're constantly at this battle trying to kind of break each other in this spirit of competition. And so, but there was often a handoff where he would find something, put it in escrow, and then it would be mine to take over from there.
That's interesting. So what's it like? So your younger brother for that matter, is now working in this full time with you? Huh.
So he's been working full time with us for the last 2 years. He's just moved back to college. He was taking a break, so he was deferring through the pandemic as college maybe wasn't the full experience he was looking for. And so he deferred throughout that timeline of working on real estate with us. He actually, I think, will be going just back to college and probably exiting real estate soon. So he's going to close the loop on all the projects that we have currently in escrow, but he has decided he's probably, it's not worth the time and the trade-off anymore for him going forward.
Some final questions for you. So I wanted to ask you, so like, what are you excited about in your business right now?
Yeah, right now it's, we started this all as like it was kind of a startup feel to it, which also meant that it was extremely chaotic and it was extremely unorganized. And so, a lot of the lenders we're out there working with, they have, checklist after checklist and all, people helping them process all of this information and data. And we're just kind of like 5 guys wake up and, all right, here's everything that needs to get done. And we all put our heads down and go at it. And for a long time, that's how it was. And we've been building systems around us very slowly and but surely. And so we've recently been putting a lot more time into those systems. Our kind of saving grace for syndications is we've just been buying on, extreme discount. So we'll buy buildings at 50% discount. And we may not have the systems to really squeeze every ounce of juice out of it that someone else could, but we got room for error here. And so that's been our strategy. But now I think we're building those systems so that we can play both sides of that coin. So that's been really exciting. One, because it lets us do things more efficient, more effectively, I guess I should say, per project, but also because it's allowing us to reclaim a lot of our time. So before, this used to be an 80-hour-a-week job for all of us. We'd wake up and eat, breathe, and sleep real estate.
Mhm.
And now, we're able to create systems that will kind of reclaim a lot of that free time and get us, the freedom to focus on some other things in life too.
Yep. Now that you're a real estate investor, what can you say? What has real estate investing done for your life now?
Yeah, it's sometimes hard to like recognize in the moment. And it's one of those, I mentioned earlier, joining GoBundance, one of the big ads for me or values for me was recognizing where my gratitude was at and where I wanted it to be.
Mhm.
And now, I'll every once in a while I'll be on a trip somewhere and be walking around with my business partner talking about real estate. Remember, there's a time in New York, and we sat down around noon and grabbed a beer at this place, and we were talking real estate. And I was like, "Wow, we're working right now. Like this is what work looks like." And we're just kind of bouncing around the city, testing, eating food, getting drinks, and talking strategy. And like it was it's an exciting realization. And so now, we can be, practically anywhere as we work. We can leverage a lot of other people's time and a lot of systems that we have, and a lot of the track record we've built to get a lot done financially and within real estate without investing absorbent amounts of our effort and energy. So it's just reclaimed a lot of freedom in our lives, and that's now translating into a lot of the benefits of travel and just life shaping in general.
I love it. And are there any big goals that you're working on this? I mean, heck, it was starting New Year's. Any big goals that you're working on this year, personal or business?
Yeah, absolutely. The first one is getting this down to less than 5 hours a week. So I'd like to keep everything moving and keep the system, the acquisition engine, as well as all the escrows and adding the value and placing tenants, all of that down to 5 hours a week or less, and just keep it running in the background. And then I'm going to be looking for I'm going to be looking to start a new business probably outside of real estate. And I don't know exactly where it's going to be, but that's a huge goal of the year as I kind of transition this, I guess, automate and systematize a lot of this real estate pipeline.
Yeah, that's awesome. What's your superpower? What's that's contributed to you're young and you're already like a success, and then like what's contributed to all your success in real estate so far?
Yeah, that's a good question. To be honest, I think it's the way I think, which is derived from a combination of things. It's been studying computer science and just taking really complex systems and problems, abstracting it out, understanding what's important, how to decouple things, and breaking that big complex problem that looks really hairy and unattackable into lots of small little problems that can be solved independently. A system can be stood up, and then you can never think about solving that problem again. That way of thinking has been extremely valuable, not just for real estate, but for life in general. Understanding, what order should I go after things in life. So that's been a huge part. And the other part is to be honest, very fortunate, like that I had a really good upbringing, really parents who loved me a lot. And that love has allowed me to move very quickly through the world without a lot of weight. And so I don't spend a lot of time dwelling on things, a lot of time with anxiety towards worrying if I did the right thing or the wrong thing, or if I should be, or worrying about the future that could come. So it's allowed me to kind of assess risk, assess upside and reward, just kind of for what they are, and move forward and make decisions. And so that has really relinquished a lot of the decision fatigue.
No, that's awesome. Are there any deals that you're raising funds for right now, out of curiosity?
We have 3 deals in escrow right now, but we are full on all of those at the moment. So I'm actually going to take a couple week break and go travel, and then come back and regenerate that pipeline. So we'll probably have some more coming up, but at the moment, I think we're not actively raising for anything.
Okay. How can somebody get a hold of you?
Yeah, I don't have any social media except Facebook, which I'm not. I just use for GoBundance pretty much. And then other than that, though, via email or text, which I'm happy to provide after, you can put them in the show notes. Email, my personal is just my name, Ryan Stenberg 10@gmail.com. So if you ever want to reach out, that's probably the best channel.
Cool. Well, that's a wrap, folks. That's all the time we have for today. Thanks, Ryan, for joining me on this episode. I love your focus and I love your drive. So inspirational. So my listeners, feel free to reach out to Ryan directly if you have any questions for him. Thank you for checking out this episode of the School of Cashflow. And remember to leave me a review on iTunes, as it helps me attract even more great guests just like Ryan. So until next time, live life abundantly.
Thanks for listening to another episode of the School of Cashflow. We hope you enjoyed our deep dive into all the tips and tricks you can use to help you on your passive investing journey. In the meantime, you may visit www.cashflowschoolpodcast.com for more great episodes. Don't forget to subscribe, rate, review, and share. That's all for this episode, folks. See you next time.